Hey Metrix Finance users, we're going to be doing a crash course on Uniswap v3, so I'm going to be walking through my process when it comes to researching Uniswap v3 concentrated liquidity pools, actually going through and finding the different pools, as well as simulating those, finding out the ranges, determining when to rebalance. All of that is going to be covered in this crash course, so make sure to stay tuned until the very end, but also make sure you have time to watch through the full video. And of course, if you guys do like what you see in the video, make sure to drop a like and subscribe when notifications turned on. This is going to be a pretty organic, transparent, and just kind of me showing you my style and what I do when I'm looking for liquidity pools to invest into. Let's hop in. So the majority of this is going to be using Metrix Finance, and a lot of the stuff that I'm going to be doing is actually going to be on the free version of Metrix Finance, but do know that some of these features will actually be in the pro version. And if you guys do want to learn more about Metrix Pro, I am going to leave a link to it down below in the description. We're also going to head into some Uniswap resources that they provide for their liquidity pools, and maybe even dive into Aperture Finance. We'll start by launching the app, and once we're on here, we're going to head over to the Discover page. Remember, the Discover page is where we can kind of find different Uniswap v3 liquidity pools. Now, obviously, you could go through, look at PancakeSwap, SushiSwap, and even some of the Solana exchanges like Orca and Radium. But once again, this crash course will be focusing on Uniswap v3. Strategies for some of these other exchanges will be relatively similar, though. Now, I'm personally going to look at the Ethereum network and some of these other networks as well, but I'll start on the Ethereum network. And I would recommend just skipping past the Ethereum network if you don't have at least $15,000 to deploy into a single liquidity pool. And that's because gas fees on the Ethereum network are relatively high, so you do want to take that into account when you are determining if you should make an investment into a concentrated liquidity pool. Personally, me, I typically deploy at least $15,000 into different positions, so I'm going to go ahead and check the Ethereum network. I'm also going to look at Arbitrum, Optimism, Polygon, as well as Base. Now, one of the Metrix Pro features is actually looking at multiple networks at once, as well as you can also look at multiple exchanges at once if you really want to. Now, if you guys are using the free version, the strategy that we're going to execute is completely possible. It's just you're going to have to look at these networks one by one as opposed to all at once like I'm doing right now. But typically, these are the networks that Uniswap has the most activity on. Sometimes I like to drop Optimism, considering that there isn't nearly as much activity on Optimism as there is on Arbitrum or Polygon or Base or even Ethereum, because that's where Uniswap is native to. But once we've kind of got our exchanges checked, I am not going to sort by TVL, because obviously the majority of these are the Ethereum network. Well, because that's where the majority of the Uniswap TVL actually is. What I'm actually going to do is sort by the fee to TVL ratio. And the reason why I'm looking at fee to TVL ratio as opposed to estimated fees is because sometimes you're going to see pools like this that show like crazy estimated fees that are obviously not going to happen. It's just in this scenario, there's a glitch in the data that Uniswap actually provides us with, because remember, we pull data directly from Uniswap itself. So we are going to have to go ahead and sort by this fee to TVL ratio, and we want to look for pools that have the highest fee to TVL ratio. Now, right off the bat, what I'm going to notice is we're going to see a lot of these different Base pools. So that gives me the indication that a lot of activity is actually happening on the Base network, but I can't actually seem to find anything that I like, and some of these are like 20,000, 15,000, 10,000 TVL. So what we can really do is we could just kind of skip past some of these. The first, second page are all Base. Third page is also all Base except one pool. So honestly, in this case scenario, I'm just going to turn off Base, and I might go and I might look at that one later on solely and do some other filters, so that way I can kind of avoid some of those meme coins and everything like that, because personally I like to invest into more blue chip liquidity pools. Once again, we're going to sort by that fee to TVL ratio, and now we're going to start to find some stuff that is way better than what we were just looking at. Typically, you'll start to find some better stuff once you get to page 2, 3, and 4. We are working on some different features that allow you to kind of filter out some of that noise that you don't want to invest into. But honestly, once I find some different pools that look relatively interesting, or maybe assets that I've heard of in the past, I'm just going to start favoriting these pools. So I've heard of Sand before, I've heard of Ram before. I'm going to favorite both these pools, and I'm going to go ahead and look back at them later on in the future. I'm also going to favorite Knockup because I have heard of that one. Normally, I would favorite the one that has OP in it, because OP token's a pretty cool token. It's native to the Optimism network. However, Optimism is a layer 2, so it does use Ethereum as the gas token, but it's cheap gas fees. But the thing is, I am going to avoid stablecoin pairs right now, mainly because if you're in a stablecoin pair, you're getting sold into the stablecoin as the price of the asset moves up. And obviously, that's not ideal in a market like we're currently in. Now, another thing I'm going to notice is I just favorited this Naka one on the 1% tier. The same exact Naka one is also on the 0.3% tier. I'm going to favorite that one as well, and later on, I'm actually going to compare the two to see which one's the best return. And then I'm going to move on into page 3. Once again, I found like Render ETH. Obviously, I'm a pretty big bull on Render if you've watched some of my videos. I've also found this Velo one. Velo is native to the Velodrome platform, which is on the Optimism network. But hey, sometimes you could pair those tokens on Uniswap, because Uniswap is just a liquidity hub, basically. And you can earn some pretty good income. And in this scenario, it looks like it has a pretty good fee to TVL ratio. So definitely going to keep that one on the favorites. Move on into page 4. Now, personally, I like to just go through the first 10 to 20 different pages. I know it sounds like a pain, but really what I'm looking for is just assets that I've heard of in the past or that have logos a lot of the times. I know it sounds kind of funny, but a lot of the times some of the noise just doesn't have logos. And the reason why it doesn't have logos is because it's new to the network, because Metrix Finance actually pulls those logos in directly from the tokens list, which are constantly updated by these exchanges and networks. So if there's a logo, a lot of the times that means that it was officially added to an exchange. But if you really want to, you can head over to coingecko.com and you could just start to search some of these assets. Like maybe there's DIMO and I want to learn more about DIMO. I could go throw it over on CoinGecko, and who knows, maybe this is a pretty solid asset. I have absolutely no clue. I look at the past 3 months of the charts and just kind of see where it's trending. As you can see, it's trending downwards. That doesn't mean that it's a bad asset. If we zoom out and we look at the 1 year, it was obviously seeing a pretty good run back in November, December, and January of this year. And then we could go and we could look at the website over on CoinGecko, and this will tell us a little bit more about what it is. And maybe this is like super interesting to me. I might go ahead and favorite it as well. Let's just go ahead and favorite it. There's also like Lido. Lido's pretty interesting to me. We could go to page 5. There's going to be some more render ones. There's Rio. I like Rio. I like Tau. I like render. So now I'm actually getting into some of these ones that I've heard of. MPL, I'm going to go see what that is. So I could just head right over to CoinGecko. This is Maple. I could pull up the website for Maple Finance and just kind of see what this is. So lending markets redefined, empowering the digital asset economy with secure, innovative lending solutions. Honestly, like off the bat, this kind of sounds like a real world asset protocol. And as I can already see, there's altcoin secured lending, corporate credit, cash management. There's some other features and stuff like that as well. So just give me some base information. It looks like it's trying to bridge that gap between kind of DeFi as well as TradFi. And that's just my initial thoughts on it. I've literally done no research on Maple. I've heard of it in the past, but I've done absolutely no research on it. I've only heard the name. But like, let's just assume that I went through a ton of different pages. I'm going to head over to my favorite pools. Now I got a ton here. I'm going to go ahead and pull that up. And as you can see, I got 17. Obviously, we can go and look at all 17 of these. The first thing that I'm going to do when I'm on this page is sort by TVL. And now that I'm sorting by TVL, I'm going to decide, hey, how much am I deploying into a single pool? And my rule of thumb is I don't want to deploy over 5% of the TVL, basically. So for example, if my singular pool is going to have at least $15,000 of capital in it, and the TVL of this pool is 100K, I am not going to want to deploy into this pool because I'm making up for 15% of the overall liquidity, which means that I'm also diluting the return that I'm getting. So I'm just going to scratch this off the list. And honestly, I'm going to scratch anything that has essentially below $350,000 off my list just to kind of narrow things down. Now, obviously, if you aren't playing with size, that's not going to be a big issue. But if you are playing with size, I would recommend kind of following the strategies just like I do. The rule of thumb, if it's above 5% of the pool's TVL, probably don't want to deploy into it because you are going to dilute returns and it won't be as consistent. Additionally, what I'm going to start to do is look for some of the assets that I actually want to include in my portfolio. So for example, I like Matic and I like ETH. Obviously, a lot of these pools are either paired with Matic or paired with ETH, so that's something to keep in mind. What I am going to narrow down is some of the assets I don't care as much about. So ideally in this scenario, you would go to CoinGecko and do some more research on these assets and really drill down into kind of what you want to include in your portfolio. So if I go ahead and pull up some of these assets, like let's just say OP token, it's currently down 4% on the day. The overall market is down 4%, so it is in line with the market pretty much. But look at the 3-month chart, not too hot. But look at the 1-year chart, it did have a little bit of a run, but even a year ago is trading higher than it's currently trading at. And what I like to do is compare it to the asset that I'm pairing it with. So if I'm looking over at, let's just say Ethereum, I'm going to look at Ethereum on the 1-year chart, and well, Ethereum a year ago was trading at 2K, now it's trading at 3K. And it peaked at 4K recently. And if I look at the 3-month chart for Ethereum, it's not nearly as harsh as the Optimism chart is, basically. Ethereum's trending upwards and then more recently downwards. Optimism, similar chart, but a lot more harsh in that scenario. It's actually in the red for the 3 months. But this isn't a bad pairing. I would want to go ahead and confirm my analysis by going over to DeFi Llama. This is just another tool that I use, and eventually we will implement this directly into Metrix Finance, just kind of something that we're working on at the moment in terms of other features. But over here on the DeFi Llama, if you scroll down till you see the tools, there's this correlation tool right here. And essentially you can look at the correlation between the assets. So this is an ETH to OP pair. I'm going to want to look at the correlation between between ETH as well as OP. So we just pull those up, and you can see the correlation over the past year, 0.85, so 85%. Over the past 1 month, 54%, and over the past 7 days, 82%. So I would say this is a pretty correlated pair, at least when you look at more recent data and more further out data. Over the past month, not so correlated. But I could just go ahead and pull this up and kind of see what we can do here, see what type of APR we're getting. So the first thing I'm going to do is look at the liquidity distribution chart and just kind of see where liquidity is at. So you can see there's a ton of liquidity over here, ton of liquidity on current price point, but it's really random when it comes to the distribution. Just something to keep in mind. I'm going to toggle the pair mainly because I don't like looking at like harsh decimals like this, like 0.000, you know, anything like that, just a pain. So I always look at kind of full numbers, which you could toggle the pair to look at full numbers. We're basically looking at how many OP tokens equal 1 ETH. That's exactly what this correlation chart explains as well. How many OP tokens equal 1 ETH over a specific period of time. So if we look back over here at March 26, 2024, the price was 918. That means at that point in time, it took 918 OP tokens to equal 1 ETH, basically. From here, this chart is trending upwards. That essentially means more OP equaling 1 ETH. Basically, since more OP equal 1 ETH, that means that ETH is the asset that is doing better because it's taking more and more OP to equal that 1 ETH. So I'm going to go ahead and drill down on my range. I typically like to use the 30-day high and the 30-day low as like kind of a base range. And as you can see, that's going to get me roughly 87% OP. I'm also nearly out of range, so I'm not going to want to use that as a range, but I will want to build off of it. So I could bring this max price up, something like that. The place where I get that buffer room from is essentially just looking at how much this price can move in a specific period of time. So over here, the price just shot up, and I'm kind of guesstimating that and just saying, okay, if it shot up from like 1176 to roughly 1485, I got to encapsulate that in my range in the case scenario we see another shoot up just like that. So I'm actually probably going to put this at around 1800. That'll put me at plus 28% from current price. It also puts me at 64% OP. Now, since OP isn't doing as good as Ethereum, I want to allocate more money to Ethereum, not OP, because Ethereum is the asset that's doing better. So I can bring this min price up until I get to about 50-50. Now, in this scenario, I'm going to use 50-50 mainly because altcoins typically do better than Ethereum. And I do think that the Optimism network could see some good runs. But at the moment, I think Ethereum is going to be the asset that does outperform, as we could see over the past 30 days. So instead of weighting it more towards OP, because I think OP is going to outperform, but in the short term, Ethereum is going to outperform, I'm doing 50-50. And instead of weighting it more towards Ethereum, since I think the OP is going to outperform in the long run, I'm just kind of doing that 50-50 mark. So I could go ahead right with this range. This gives me about 142%, it says, but we need to drill in on this, right? And we need to look at two things for consistency. Number one, liquidity distribution, as well as number two, volume history. So as you can see, we're right to the right of this pretty big spike on liquidity. If I move this price around, you can see over here, I'm getting like 505%. And then over here, I'm getting like roughly 140%. And then if we're at the top of this liquidity distribution, we're actually getting 70%. So since we're right to the right of it, it looks like we're actually going to get 145%. We're not actually going to if this person that has a big block of liquidity moves their liquidity to a new range, or if the price reverts right back over here where that liquidity is. So we would assume I'm getting roughly 70% APR. And then we would look at the volume history and say, okay, well, recently the volume has picked up over the past 4 to 5 days. But if you look at this period, there's this period where there wasn't nearly as much volume, and there's a period where there was super high volume. So I'm going to want to keep everything the same, keep that price at the top of distribution, but I'm going to want to look at this calculation range over the course of a couple different periods. So I'm going to start off by 1 day. That shows 87%. I'm going to go to 3 days. That shows 105%. 5 days goes to 88%. 7 goes to 73%. 9 goes to 65%. 11 goes to 58%, and then over the course of, let's just say, like 14 days goes to 55%. So I like to assume worst case scenario about 50-55% in this pool. Best case scenario is going to be obviously over 100%. Kind of right there in the middle is that average that we're getting over the course of like 1 day, around 75 to 85% basically. So my worst case about 55, my best case a little over 100. Probably what I'm going to end up getting is about 75 to 85. So what I would essentially do is determine, hey, am I happy getting 55%? Because that's the worst case scenario. And if I am happy getting 55%, I will add this pool to kind of my, what I like to call my compare tab. It's just where I save pools while I'm looking at different options. If you go into compare, you can essentially add different pools in here and you can compare different pools. It's pretty simple, but I'll just pull it up. This is ETH OP on the 0.3% tier on Optimism. So we just pull that up over here. By the way, I want to go ahead and mention that this compare tool is a pro feature. But if you don't have pro, once again, you could just write this down on a spreadsheet. But, sometimes spreadsheets get annoying and you just prefer to have a really good software to do it for you. That's where Metrix Pro comes into play. Once again, I'm going to toggle that pair because that's what I did over on here. And I'm literally just going to copy the min price as well as the max price and then also my calculation range and my current price basically. And then from there, I'm just going to leave that there. And as I start to find different pools and do my analysis, I'm going to start to look at them on the compare page so I can actually compare them side by side and decide which ones I want to deploy into. Now, once again, I'm allocating roughly $15,000 per position. So I'm going to change that deposit amount to $15,000. We're estimated to yield about 35% on the average end of things. Remember, that's using the 1-day range. And if we use like 14 days, we're getting about 55%. So at 55% APR, that's about $23 a day. Once again, gonna head back over to my Discover page where I have my favorite pools. You guys can keep the pool on here if you really want to, or you could just remove it. I like to remove it because I want to be able to see what I have left to actually look at. And once I've determined if it's a good pool, I typically add it over here to this compare tool. And this saves basically to your account essentially. So once it's on here, I already know what it is and I already know, hey, I've done my due diligence. This is probably one I want to get into, or these results are looking somewhat promising. Let me add it to my list of actual good stuff as opposed to just completely bad stuff. Now I do want to take a look over at something that I personally think isn't going to be too hot. I'm going to look over at this ARB to ETH pool basically. And what you'll occasionally notice is that current price will once again be a little bit to the right or to the left of that liquidity distribution. And if it is in this scenario, it shows, oh, we're getting 170%. But once again, you got to move that price to the top of distribution to assume the worst case scenario and assume that the people providing liquidity over here move their liquidity to current price or price swings back to where the liquidity is. In this scenario, the current price is literally right at the top of distribution basically, or at least near the top. So makes it pretty easy on us. I'm also going to look at volume history, see that recently that volume has picked up. So we'll keep that in mind when it comes to adjusting our calculation range later on. Actually, and if we look at this chart, you can see it looks relatively similar to the ETH to OP one. And that's because Arbitrum and Optimism, they essentially do the same exact thing for Ethereum. They're layer 2 scaling solutions. Obviously, they have their different ways of doing it. Obviously, one's more popular than the other. But at the same exact time, the tokens are trending in the same direction. And the charts are looking very, very similar. But like even with a range like this that shows 20%, and personally, I don't think 20% is worth the risk that I'm taking on providing liquidity for ARB token. Especially because if we pull up ARB token over on CoinGecko, you're going to notice that it hasn't done well over the past 3 months. It went from $2.25 all the way down to like $1.10, and at worst case it actually dipped below $1. But if we do compare it to Optimism did the same exact thing. So both of them lost 50% of their value, or I should say over 50% of their value in the time span of about a month and a half. So maybe we need to factor that in and say, hey, well, if it's doing that bad, maybe we shouldn't deposit into it. Or maybe if we're super bullish, we can say, hey, this is a pretty good entry price to get in at. Maybe we can ride it on the way up. And since these tokens are pretty correlated, well, we're not going to have as much impermanent loss, and we're mainly going to be collecting those fees from that APR. So I personally wouldn't even bother deploying into ARB. I'm just going to go ahead and take this one off of my list. I'm going to look into something that I've never looked into before, which is this ETH to GFI. I've never even heard of GFI. So let's keep that in mind. Once again, going to go ahead and pull up the asset on CoinGecko just to kind of see what it is. Looks like it is Goldfinch token. I like to make sure that the logos match up. In this case scenario, one's light theme, one's dark theme, but they're also both a bird and they're the same exact bird. So I'm just going to say, hey, this is the same exact token basically. This one is on the Ethereum network, so we ideally do want to be doing a higher return than 100% per year, even with 15K. But once again, we're going to do that same exact thing. We're going to use that 30-day high, which in this case scenario is all the way up here. I got to manually type it in because the slider bar doesn't even go that far. It's 2260. And then over here, we're going to use the 30-day low. And when we do that, you're going to notice that we have about 25% Goldfinch and about 75% ETH. But in this scenario, Goldfinch did really, really good, and then it started to consolidate, basically. So I would want to narrow in on my range. I'm probably going to even adjust this calculation range to something like 14 days, just so I could look at more recent data. And now I could go ahead and use that kind of high and that low, basically. Over the past 14 days, it looks like ETH had its little run and did better than Goldfinch. But for the most part, they are relatively correlated, so let's keep that in mind. This is a relatively tight range, especially for some random asset that I've never heard of that, probably has a lot of volatility. Yeah, a lot of volatility. It's up 123% in the past 30 days, down 25% in the past 14 days. So we're going to go ahead and just accommodate for that. So in my range, I'm going to bring that up to like plus 48%. I'm literally just going to double it on both ends so I can double my overall range. And then that gets me about 57% Goldfinch. If I am bullish on Goldfinch, I am going to want to have like 60% plus, so maybe 60%. The more bullish I am, the more I'm going to have in the pool to start off with. If I think, hey, there's absolutely no chance that Ethereum is even going to do a drop better than Goldfinch, well, then that's where I could have 90% Goldfinch. But I'm not that bullish on it. Maybe I just think, hey, it's been doing well recently, so let me go ahead and just wait a little bit more, like 60% or something like that. That's where I would use 60%. And I just like to even off these ranges. We'll use a range 420 to about 1175. That gets me a 418% APR, so definitely hitting those metrics for the Ethereum network. Looking at the volume history over 14 days, you could see that volume has definitely dipped off over the past 14 days. Let's change that to like 7 days. And that looks a lot more consistent, if anything, picking up a little bit. Getting 335% here. Current price, once again, going to move to that top distribution area just right there. And as you can see, when we are right there, we're getting about 280%. $15,000 estimated make me about 115 bucks a day. I'd say that's pretty solid. Going to go ahead and add this to my compare tool over here. Once again, this one is on the Ethereum network. It's GFI with ETH, and it is on the 1% tier. So as you can see, that's where all the liquidity is, which is why this one's doing such a high return, because it's 1% tier. And then I'm going to go ahead and throw in my numbers over here. $15,000 deposit amount. And then my calculation range, I'm using 7. I'm going to copy that current price. Once again, flip that pair. And then, of course, I'm going to go ahead and grab the range 420 to 1175 and just throw that up over here. And now I got both my pools side by side, and I know exactly which one's doing better. As you can see, this Goldfinch one is doing a lot better. I have to determine if it's worth taking on the risk on Goldfinch as opposed to OP, but getting like a much higher return. But also if this is going to be consistent, which it looked like it from the liquidity distribution as well as the volume history, because the gas fees on Ethereum are going to be pretty hefty. But Goldfinch, number 227 by market cap. If we take a look over at OP, you could see number 47 by market cap. So we can naturally assume that Goldfinch is probably going to be more risky. Once again, market cap doesn't necessarily mean that it's risk-free or that it's not as risky of a specific asset, but sometimes it is a good judgment. One last thing I'm going to go ahead and mention on this before showing you exactly what I'm doing, like when it comes to deploying and everything like that, is don't forget to revert the current price back over to the actual current price, not the top of the distribution, because you can see this current price gives us 67% Goldfinch, when in reality, the actual price gives us 60%. That's why I changed the current price last, and I look at the volume history last, because I want to look at 30-day charts when I'm doing my analysis and creating my range. I want to look at the actual price when it comes to actual deposit amounts for each asset. But I want to actually assume the worst case scenario for the estimated fees. But by changing it back, that tells me how much of each asset I actually need. So I'm going to go and I'm going to grab 61% GFI and about 39% WE. I could use the DeFi Llama swap, which is called Llama Swap, or I could just go ahead and purchase some ETH and head over to aperture.finance. Regardless, I personally use Aperture Finance when it comes to actually deploying into liquidity pools because they have features like Zap and they have some other automation features, and just ease of use is way better on Aperture as opposed to Uniswap. Good thing about Aperture is it interacts directly with the Uniswap smart contracts. But from here, I would essentially connect my Rabby wallet. That's the wallet I'd use, but you can connect any wallet that you use. You would hit new position, and then when it comes to token pair, once again, we're going to throw in ETH, we're going to throw in GFI. If GFI is not showing up because maybe it's a newer asset or maybe you're using an asset that's not yet on Aperture's token list, you can head over right here, this little icon. It opens up the info Uniswap page, and then from here you can click right on the token and just grab that contract address in the top URL. And then if we go ahead and we paste that in here, you can see it also pulls up with Goldfinch basically. And before I even go into deploying positions, I do want to mention occasionally you might pull this up on the Polygon network and notice nothing loads. That's because this page is actually a little bit outdated. If you head over to the app.uniswap.org page and go to explore, this is kind of the updated page, and it actually factors in V2 as well as V3 Uniswap, not just the info.uniswap.org, which only factors in V3. But assuming like we're on Polygon network or something like that, and maybe we want to look at render token, well, we would essentially just pull up render token over here. URLs are going to be the same. We could just throw the pool address in here, but it'll actually tell us some pools over here. So we can use this when it comes to discovering pools. One thing I actually like about this explore page, I haven't really used it a ton, mainly because it's new, is it does tell you a little bit about the project, and it actually gives you the websites and stuff like that. So theoretically, we don't even need to use CoinGecko because it's all on this Uniswap explore page. But sometimes it has data issues like this, showing it's at like $1, and then other times it's at like $11. So that's where CoinGecko will be a little bit more reliable. But this is a pretty cool site to just have in your back pocket when it comes to some specific things. Maybe you want to go and look over there. But heading back into Aperture, I'm going to check this zap in feature, because if I just have ETH, essentially zap in is going to let me only deploy ETH, and it will automatically go ahead and execute that trade to fit that 60-40 ratio that we came up with. But what I personally recommend doing is heading over to DeFi Llama's Llama Swap, purchasing the 60-40 basically. So you have basically 60% GFI and 40% ETH, and then actually going over here and add liquidity with same tokens. Because even if you do the exact prices, there's sometimes just like trades that happen to the point where you did the exact prices, you did everything right, but then a trade executed within that like 1 to 2 minute period where you actually went to deploy, to the point where now you're like deploying like $100 less or $1,000 less depending on your overall size, and you're missing out on putting like 2 to 3% extra in your position. So that's where you'd want to do same tokens and hit max next to both them, or deploy the amount of ETH and the amount of GFI you just purchased, and then enter in your range right here. So we used a range of basically 420 to 1175. So we would throw in our range 420 to 1175. And then we would hit max, and it would automatically go ahead and execute a trade to fit that asset ratio after we hit open position. So that's the way to maximize the amount of money that's actually going to the LP, as opposed to having some that like kind of sits on the side because there was a trade that kind of messed up pricing terms basically between when you calculated as well as when you actually deployed. But that's exactly my Uniswap strategy for going through and actually simulating different positions. As I mentioned, pretty much everything I did is available for free, but there are some convenience things like being able to browse on multiple networks at once, or hey, maybe browse on multiple exchanges at once at the same time. Basically, that's going to be in Metrix Pro, but once again, you can avoid that and accomplish the same exact thing just in a longer period of time by browsing exchange by exchange by exchange, basically. And then there's also going to be like kind of the compare, where you can actually, instead of just using compare, throw it on a spreadsheet if you really want to. I just like the convenience of being able to have, you know, the software do it for me essentially, and have it in that sleek dashboard, and be able to easily change numbers and instantly see those outcomes, as opposed to writing on a spreadsheet, go back to Metrix Finance, go back to my spreadsheet, and keep swapping back and forth. And hey, it looks like even if I deploy like $1,000 in this GFI position, it's making me about $26 per day. And currently at the time of recording this video, Metrix Finance Pro is $35 a month. So basically about a day and a half of yield typically pays my subscription for Metrix Finance Pro. But yeah, I hope you guys enjoyed this deep dive and this kind of crash course on how I actually find high performing Uniswap V3 pools, how I take that information and actually start to simulate, as well as formulate a portfolio and deploy into positions. I'm going to leave the links for Metrix Finance down below in the description. Once again, if you guys did enjoy this, make sure to drop a like and subscribe, notifications turned on. We'll see you guys in the next one. Peace out.